Hello, everyone, and welcome to this week's Wealth Enhancement 7 Market Movers. My name is Doug Huber. I'm the Deputy Chief Investment Officer here at Wealth Enhancement. Let's get into what was a pretty big week for headlines, and starting with the fact that the Federal Reserve cut rates for the second time this year. They moved their benchmark policy rate down another 25 basis points, or 0.25%, in a move that was widely anticipated by the markets. But I think what came out of that in the post news conference was ambiguous comments from Fed Chair Powell that has put in question what the future might look like for additional rate cuts both this year and around the corner in 2026. I think let's start with one of the big kind of canaries that we're watching right now is obviously on October 1st, we entered a U.S. government shutdown. And from that, we're delaying key economic data releases. And that creates uncertainty both for investors and the policymakers. Looks like the Federal Reserve is in a bit of a holding pattern. I mean, obviously, we did have this week's cuts, but the recent comments suggest officials are a little bit more cautious about declaring victory over inflation at this point, even as the market continues to price in more cuts this year. Corporate earnings, big week this week for equities releasing Q3 earnings, and they've been generally really good, exceeded expectations, not unanimous, not across the board, but definitely in a lot of areas, especially outside of tech. So it's interesting to see that, and we'll talk a little bit about the broadening beyond those mega cap tech names, especially into industrials, consumer, and some healthcare names. And then on the fixed income side, I think that the long-term end of the yield curve, so I think 10 to 30 years of the U.S. Treasury curve, has ticked higher. I think really driven by some of that ambiguity from the Fed, and that maybe future rate cuts and the timing of those maybe were not as certain as the market was predicting. For this week, let's talk about kind of some of market performance. Equity markets mostly advanced this week, a little bit of up and down, but on the week to date, they are positive. And the participation has broadened, as I mentioned, beyond kind of that large cap growth sector. Volatility has remained pretty low, and the S&P continues to hover in and around record levels. On the fixed income side, Treasury yields are finishing a little bit higher. They had dipped below 4%, especially at that 10-year kind of key rate there, but we're back up a little bit over 4.1% as of the close on Thursday, which is up slightly from last week. But on the corporate side, credit spreads continue to tighten, and that's a reflection of the market saying corporate balance sheets look really good, and they're not really at the moment pricing in some credit event from anything going on in the economy or just the overall health of the businesses. I think what this all means is investors are sitting here balancing solid corporate earnings, what we'll in the near term anticipate is easing inflation pressures. But that's balanced against a lingering uncertainty over fiscal policy, the timing of those rate cuts, and if there is a broader impact of this government shutdown. Speaking of the shutdown, as we mentioned, one of the negative side effects of that is that it has limited the economic data that we've had available, both on the inflationary side and on the labor side. And as a reminder, that is really what the Fed looks at. They have a dual mandate. They need to keep full employment and inflation at bay. And so without perfect data, they're kind of flying a little blind. And I think that definitely was reflected in the Fed comments and some earnings guidance this week. The improvement in market breadth definitely signals a healthier participation, but the extended rally we've had recently without a significant pullback is interesting and will be one to watch. Markets have been broadly positive since the better part of late Q2. With that, I think overall the feeling here, at least this week, and has been for a little bit of time now, is there's this cautiously constructive tone. Solid earnings and stable inflation data are certainly supportive of risk assets. But that policy, the ongoing shutdown, certainly introduces a new variable. And I don't think it's market moving yet, but it is certainly capable at some point, if this continues to extend, of influencing both sentiment and economic data. And so this interplay between monetary and fiscal uncertainty is definitely shaping a near-term positioning in equities and bonds at the moment. On the whole, I think we're just continuing to watch confirmation for these inflation trends to ease, and the growth data, where it becomes available, continues to remain resilient, right? We don't think it is totally off to the races in terms of growth, but what we need to see is some stability that we will have moderate growth moving forward. I think heading into next week, attention's going to be on any movement toward a government funding resolution. Everybody's kind of on the edge of their seats to get this shutdown done. And I know there's our litany of reasons why, and probably a lot more important than just market movements, right? We got to keep planes in the sky and people paid to do a lot of the things that keeps the economy running. And so we definitely want to see some resolution there. And with that resolution, what will come out of that is we will get better data around some of the things we're monitoring. And so with that, I think we look forward to talking to you next week. Hopefully there's a little bit more information. Hopefully we have more good news as it relates to how markets are moving, but I think more importantly, good news around the fact that we're going to get a little more clarity. And as we've said all year long, the market can handle good and bad news. What it can't handle is uncertainty. And so the more certainty we can bring to the markets, it helps with not only how our portfolios perform, but also the decisions we make around how we position them. So we thank you for tuning in this week. We look forward to talking with you next week. Thanks so much.